How to build a diverse investment portfolio. Diversification is a fundamental principle in investing that helps minimize risk by spreading investments across different asset classes. Instead of putting all capital into a single investment, a diversified portfolio reduces the impact of poor performance in any one area. For example, during the 2008 financial crisis, investors with diversified portfolios that included bonds and commodities fared better than those heavily invested in equities. Similarly, in the COVID-19 pandemic market crash, technology stocks rebounded faster than other sectors, benefiting investors who had exposure to multiple industries. A well-diversified portfolio typically includes a mix of asset classes such as stocks, bonds, real estate, and alternative investments to achieve balanced risk and return. Before constructing an investment portfolio, it is crucial to assess personal risk tolerance. Risk tolerance is influenced by factors such as financial goals, investment time horizon, and emotional ability to handle market volatility. Investors can determine their risk tolerance through interactive quizzes or by considering hypothetical scenarios. For instance, someone nearing retirement may prefer a conservative portfolio with more bonds, while a young professional with a long-term horizon might favor higher equity exposure. Example: portfolios by risk tolerance. Conservative: 50% bonds, 30% stocks, 20% real estate. Moderate: 40% stocks, 30% bonds, 20% real estate, 10% alternatives. Aggressive: 70% stocks, 15% bonds, 10% real estate, 5% alternatives. Building the foundation core asset classes. A strong portfolio starts with core asset classes that provide stability and growth. Stocks represent ownership in a company and offer high potential returns, but come with greater risk. Bonds provide fixed income and act as a hedge against stock market volatility. Real estate offers long-term appreciation and income potential through rental properties or real estate investment trusts, or REITs. Balancing these asset classes according to one's risk tolerance ensures a solid investment foundation. Adding diversification with alternatives. Beyond traditional assets, investors can enhance diversification with alternative investments. Commodities include gold, silver, and oil, which hedge against inflation and currency fluctuations. Cryptocurrencies are high-risk digital assets that provide potential high returns and portfolio diversification. Private equity involves investments in privately held companies that offer long-term growth opportunities. Strategic allocation of these assets should be based on the investor's financial goals and risk appetite. Rebalancing and monitoring your portfolio. Over time, market fluctuations can shift the balance of a portfolio. Regular rebalancing ensures that investments remain aligned with the desired asset allocation. Key strategies for portfolio maintenance include periodic rebalancing, which adjusts investments to maintain the intended asset mix. Performance monitoring helps track investment performance and market trends to make informed decisions. Professional guidance, whether through consulting financial advisors or using robo-advisors, can provide expert portfolio management. By continuously monitoring and adjusting investments, investors can optimize returns while managing risk effectively. Conclusion: building a diverse investment portfolio is essential for long-term financial success. By understanding risk tolerance, allocating assets wisely, incorporating alternatives, and consistently monitoring investments, investors can achieve stability and growth regardless of market conditions.